Ever thought your average savings account could start doubling or even tripling in returns with no extra effort from you? Now, that's a game changer. Welcome back to our channel, where we talk everything about making money. In today's video, we will unpack an unexpected field, peer-to-peer lending and microloans. This might sound sophisticated, but trust me, by the end of this video, you'll have all the knowledge at your fingertips to dive into this hugely profitable sector. We'll cover everything from understanding the basics of peer-to-peer lending, to step-by-step strategies for getting started and managing risks. Stay till the end because we won't just tell you what to do but we'll also share invaluable tips that I wish I knew when I began. Also, we have a bonus tip that could potentially multiply your returns, so make sure you stick around and discover all the secrets. Let's turn your savings into a money-making machine. Research various peer-to-peer, P2P, lending platforms. Prosper Marketplace. Launched in 2006, Prosper was the first peer-to-peer lending marketplace in the United States. It offers personal loans from $2,000 to $40,000, with an interest rate ranging between 6.95% and 35.99%. The platform rates potential borrowers based on a proprietary Prosper rating, which helps investors evaluate opportunities. Lending Club. Founded in 2007, Lending Club operates as an online credit marketplace and is one of the more recognizable names in P2P lending for personal loans in America. They offer loans up to $40,000 for personal use, business, auto refinancing, and even medical procedures. They offer competitive rates and are a popular option for both borrowers and investors. Upstart. Founded by ex-Google employees, Upstart leverages artificial intelligence and machine learning to price credit. Besides the traditional credit score, the platform also considers factors like education history, area of study and job history while appraising borrowers. Loans range from $1,000 to $50,000, with APRs starting at 7.35%. Funding Circle. Established in 2010, Funding Circle is a P2P lending platform designed for small businesses. It offers loans ranging from $25,000 to $500,000. The term lengths range from 6 months to 5 years with interest rates starting from 4.99%. Zopa. A UK-based P2P lending platform, Zopa started operations in 2005. It offers personal loans as well as auto loans. It has lent over £5 billion to UK consumers so far and has over 750,000 investors. Peerform. Founded by Wall Street executives, Peerform is a P2P platform that offers personal loans from $4,000 up to $25,000 for a period of 3 years. The APR range is 5.99% up to 29.99%, depending on borrower qualifications and loan terms. Sophie. Sophie, Social Finance Inc., is an online finance company that provides student loan refinancing, mortgages and personal loans. They offer personal loans starting from $5,000 to $100,000, which are among the highest in the industry. RateSetter. RateSetter is another UK-based P2P platform, but it also operates in Australia. The platform matches investors with individual or business borrowers and offers both secured and unsecured personal loans. Mintos. This is a global P2P platform that allows investors to invest in various loan types including personal, business, and automotive. The platform operates with multiple lending companies around the world instead of directly with the borrowers. Bondora. Bondora is a P2P platform in Europe, headquartered in Estonia, and offers returns as high as 6.75%. Also, it provides Go and Grow, auto investment tool which simplifies the investment process. The growth of P2P lending platforms has opened up new, exciting, and potentially lucrative opportunities for investors while providing an alternative source for personal and business financing. However, potential investors and borrowers should always do their homework before choosing a platform. Sign up and create an account on your chosen platform. Signing up and creating an account on your preferred platform is a straightforward process that allows you to unlock the full services and features of the platform. You may have a platform in mind such as a social media site, an online shopping site, a job portal, a digital marketing site, a financial platform, a learning platform, and so on. Regardless, the process is usually simple and user-friendly. The following are general steps to sign up and create an account on your chosen platform. Open the platform, either download the app from the App Store or Google Play, or directly access the website from your browser. Locate the Sign Up or Create Account This button is usually found on the home page of the website or app. Enter basic information. After you've pressed the Sign Up button, you'll usually be asked to fill out a form with your basic information. This usually includes your full name, desired username, password, and other information such as your email address or phone number. Verification. To ensure that it's actually you signing up, the platform usually sends an email or text message containing a verification code. Input this code into the required box to verify your account. Security measures. For better security, many platforms encourage or require you to set up a two-factor authentication step, in addition to a password. Profile setup. After creating and verifying your account, you're usually prompted to complete your profile. This may involve uploading a profile picture, adding a short bio, or specifying your interests. Finally, you may be asked to agree to terms of service or privacy policies to complete your account setup. Remember to note down your username and password for future logins. Happy exploring your new platform. You're all set to enjoy the features of your chosen platform after setting up your account. Understand the platform's terms and conditions. Understanding the platform's terms and conditions is a crucial step before engaging or participating in any online platform. These terms and conditions are an agreement or a contract that acts as a legal bridge between the platform provider and you, the user. The terms and conditions read out the boundaries, privileges, responsibilities, and rights for overall platform usage. Governance of use. The terms and conditions outline in what manner the platform can be used. This commonly includes restrictions on behaviors including hacking, spamming, harassment, and the use of offensive language. Intellectual property. The agreement provides information on content ownership. It informs whether platform providers have any proprietary rights on users' posts or contributions. Similarly, it also clarifies if any content on the platform, such as images, video, text, are copyrighted or trademarked, thereby restricting unauthorized usage or distribution. Data protection. These terms indicate how your personal data will be used, stored, and protected. It also clarifies the extent to which your data may be shared with other parties. Termination of service. Most agreements consist of a clause detailing how and under what circumstances an account can be terminated or suspended. It is crucial to understand under what conditions the platform can enforce this, and whether any appeals can be made. Payments and refunds. If the platform involves any financial transactions, the terms and conditions will detail payment methods, billing cycles, refund policies, membership cancellations, etc. Updates and changes. Platforms often reserve the right to alter their terms and conditions. It might be your responsibility to keep abreast of these changes. Dispute resolutions. Most contracts will elucidate on how conflicts or disagreements will be resolved between the platform and the user. User age restrictions. Platforms also indicate the permissible age limit for users in their terms and conditions. In conclusion, understanding the platform's terms and conditions provide a clear perspective on what you are getting into and how your conduct should be while using the platform. Ignorance of these terms does not excuse non-compliance, and thus they should be read carefully. Decide on your investment limit or budget. Before venturing into investments, each investor should have an understanding of their investment limit or budget. This refers to the maximum amount of money they are comfortable and able to invest in a particular venture. A prudent investor should be prepared and very much willing to lose the money they invest without it affecting their overall financial health and lifestyle. Deciding on an investment limit or budget requires careful financial planning. Your income, expenses, savings, future financial goals, risk tolerance, and the expected rate of return are important factors to consider. Set a budget that aligns with these aspects. Here is how. Evaluate your financial situation. Examine your current financial situation. Consider your income, savings, expenses, and debts. Calculate the disposable income you have after fulfilling all your financial obligations. A portion of this can be considered for investments. Prioritize your financial goals. What are your financial goals? Is it to buy a home, start a business, or build a retirement fund? How soon do you want to achieve these goals? Determining your financial goals will help you decide how much to invest and where to invest. Understand your risk tolerance. Risk tolerance varies among individuals. Some are aggressive investors willing to take higher risks for higher returns, while others may want to stick to safer investments that offer moderate, but steady returns. Your risk tolerance can influence your investment limit greatly. Maintain an emergency fund. Before you decide on your investment budget, ensure you have an emergency fund in place. Aim to have about 3-6 months worth of living expenses stored in a readily accessible account like a savings or money market account. This acts as a safety net in case of financial emergencies, leaving you free to invest without worrying about immediate needs. Diversify your investments. Never put all your eggs in one basket. Spreading your investments across different asset classes reduces the risk and could maximize returns. Review regularly. An investor should review their portfolio regularly and make necessary adjustments based on performance and changing financial goals. Remember, an investment budget should not stretch you thin. It is not advisable to invest money that you cannot afford to lose. At the same time, also consider the opportunity cost of not investing or underinvesting. Always aim for a balance between risk and returns. Professional guidance from financial advisors can be very beneficial in making these decisions. Research and select potential borrowers. Comprehensive research is a crucial aspect of selecting potential borrowers, particularly for lenders such as banks, microfinance institutions, and other financial service providers. In-depth research can provide considerable insight into the borrower's financial health, repayment ability, credit history, and overall risk profile. This information is vital to make well-informed lending decisions and minimize potential credit risk. Investigate credit history. One of the key steps in the borrower selection process involves a thorough examination of the potential borrower's credit history. This includes detailed information on past and current debts, repayment timeliness, credit utilization ratio, and the types of credit used. Credit history provides a clear picture of how responsible and reliable the borrower has been in fulfilling past credit obligations. Determine repayment capacity. A potential borrower's income, employment stability, expenses, and existing financial obligations are all factors to consider when determining their repayment capacity. Lenders typically assess this by calculating the debt-to-income ratio, DTI, which should not exceed 35-43%, as per guidelines set by most financial institutions. Evaluate collateral. If the loan is secured, the lender will need to evaluate any collateral that the borrower offers. This could involve analyzing property or asset value, its liquidity, and the feasibility of seizing and selling the collateral if the borrower defaults. Assess business financials. In the case of business loans, lenders need to study the company's financial statements, including balance sheets, income statements, cash flow statements, and others. This helps ascertain the company's financial status, profitability, operational efficiency, as well as its ability to meet its debt obligations. Industry research. For business loans, lenders also need to conduct industry research to understand market trends, industry growth rate, market competition, regulatory environment, and other relevant factors. This research helps in assessing potential business risks and the viability of the business in long run. Conducting personal interviews. Personal interviews can provide qualitative insights into a borrower's financial discipline, future plans, and overall attitude towards debt repayment. By asking the right questions, lenders can gauge the potential borrower's seriousness and dedication towards repaying the loan. Therefore, meticulous research and evaluation of potential borrowers enable lenders to identify less risky borrowers, thereby reducing the likelihood of loan defaults while ensuring profitable lending operations. It also facilitates a healthier credit environment and promotes financial inclusion by allowing creditworthy borrowers easier access to loans. Start lending by buying shares of loans. Start lending by buying shares of loans is essentially referred to as peer-to-peer, P2P, lending or crowdlending. It offers individuals the opportunity to become microfinancers who can buy shares of loans through an online platform. In this type of lending, borrowers receive loans for various purposes. It can be for starting a new business, expanding an existing one, paying off debts, or personal use. The operations are run on a lending platform where borrowers apply for loans, and interested lenders, instead of lending the full amount, can buy shares of these loans. For instance, let's say a borrower needs a loan of $10,000. Instead of one lender footing the entire amount, 10 lenders could each buy shares worth $1,000. As a lender, this approach helps you spread your risk exposure since your money is not tied to a single borrower's ability to repay the loan. It also allows lenders to step into the shoes of banks and financial institutions but with more control over where their money is invested. After buying a share of a loan, lenders earn interest depending on the agreed terms of the loan. The interest rates are usually preset and based on the borrower's risk level, measured by credit scores and other financial indicators. The repayment schedule, as well as the tenure of loan repayment, varies and is agreed upon before initiating the transaction. In case a borrower defaults, the online platform usually has a recovery procedure in place to help lenders recover their money. There are several online platforms worldwide that offer opportunities to start lending by buying shares of loans. A few of such platforms include Lending Club, Prosper, Zopa, and Peerform. Through these platforms, both borrowers and lenders can mutually benefit. Borrowers get their much-needed funds, and lenders earn competitive interest rates compared to traditional investments. However, lending by buying shares of loans does have its risks. It's crucial for potential lenders to research extensively on the borrower's credibility and purpose of the funds. Diversification is also key. By distributing your funds across different borrower profiles, you may potentially reduce your risk. Furthermore, it's advisable to start with a small amount until you understand the process thoroughly and gain some experience. In short, starting lending by buying shares of loans offers individuals an opportunity to earn higher returns and diversification, but it does involve some risk, so precaution is necessary. Use automatic investment tools if available. Investing can often be complicated and time-consuming. That's where automatic investment tools come in handy. These tools simplify the process drastically, requiring less time, and providing accessibility to everyone, regardless of their financial knowledge or expertise. Automated investment tools or robo-advisors use algorithms to manage and balance your investments. They make use of technology to reduce the costs of traditional investment advising. This strategy can be highly beneficial to new and experienced investors equally. One great use of these tools is for regular, automatic investments. Once you set the frequency and amount of your contribution, the tool purchases the investment at that rate. This enables dollar cost averaging, which can effectively reduce the impact of volatility in your investments. Furthermore, automatic rebalancing is another advantageous feature offered by these kinds of services. Over time, gains or losses in one area of your portfolio may cause it to deviate from your original desired allocation. Automatic investment tools can detect these variances and rebalance your portfolio accordingly. Tax loss harvesting is one more benefit. It allows you to use the losses in your portfolio to offset your capital gains, potentially reducing your tax bills. The availability of tax loss harvesting can be a significant factor to consider when choosing an automated investment tool. Automatic investment tools, however, should not replace proper financial planning and management. They are tools designed to minimize human intervention and bring about consistency. The automatic savings help you stick to your financial goals more effectively. Still, it's crucial to remember that investing always comes with risks, and it's important to do your share of researching before settling on any investment strategy or tool. It's also pivotal to review and monitor your investments periodically, ensuring they adhere to your financial goals and risk tolerance despite the high degree of automation. Diversify your investments among different borrowers. Investment diversification is a strategy that attempts to spread risk by selecting a variety of investment types within a portfolio. In terms of loan investments, this denotes spreading your investments among distinct borrowers. If your investment portfolio involves only a single borrower or a small group of borrowers, you expose your money to intensive risk. This could amount to putting all your eggs in one basket, a strategy typically denounced in the investment world. When you diversify your loans across various borrowers, you considerably decrease the risk of seriously damaging your portfolio. For instance, let's say you have $10,000 to invest and you loan it all to one borrower. If the borrower defaults on the loan, you lose all of your investment. However, let's assume you divided the $10,000 among 100 different borrowers. Even if a few borrowers default, the majority of your investment is still secure. Furthermore, diversification allows you to expose your portfolio to a variety of borrower types. Borrowers differ by factors such as income level, employment stability, credit rating, and others. When you diversify, you're not just banking on one type of borrower or loan. Your portfolio could include a mix of high-risk, high-return potential loans, and lower-risk but more stable loans. In diversified investment, investors also benefit from the law of large numbers. This law in probability theory suggests that as a sample size grows, its average is likely to get closer and closer to the average of the whole population. Hence, a diversified portfolio of many loans might be expected to behave more like the overall market, smoothing out the impact of any single loan. Lastly, keeping your investments distributed among different borrowers can give more consistent returns from your portfolio and reduce the volatility you might see from investing in one borrower. Therefore, loan diversification is a sage strategy for anyone looking to build a strong and robust investment portfolio. Monitor and review your loan portfolio regularly. Monitoring and reviewing your loan portfolio regularly is a crucial practice for both individual investors and financial institutions. This activity involves consistently tracking and analyzing the performance of your loans to ensure they are generating the expected return and not posing an extensive risk to your financial health. One primary reason for consistent monitoring and review is to recognize the early warning signs of a potential default. By keeping a close eye on your portfolio, you can detect if a borrower begins to miss payments, thus taking necessary measures before the situation worsens. Moreover, this approach allows you to spot trends or changes in the borrower's behavior, which might indicate alterations in their financial situation. Regular reviews also assist in ensuring your portfolio aligns with your investment or lending goals and strategies. Over time, your objectives or risk appetite may shift. Regular reviews ensure your portfolio reflects these adjustments. For instance, if you initially focused on high-interest, high-risk loans, but now want to mitigate risk, you might decide to include more secured or low-interest loans in your portfolio. Besides, it is also essential in risk management and diversification. It helps you identify any undue concentration of loans, like having too many loans in a specific industry or with a particular type of collateral. By reviewing your portfolio regularly, you can maintain a balanced mix, spreading your exposure across different loan types and sectors. Moreover, regular monitoring and reviewing make sure you comply with various regulatory requirements. For lenders, there are often regulations stipulating how much they can lend to certain sectors, or how large a proportion of their portfolio can be high-risk loans. Regular reviews ensure they are on the right side of the law. Lastly, it can also help in making informed decisions regarding buying or selling existing loans. By knowing the performance and the potential risks associated with the loans in your portfolio, you know when it's the right time to offload certain loans or seek new ones. In conclusion, regular monitoring and reviewing of your loan portfolio is an integral part of loan portfolio management as it helps in early detection of potential defaults, risk management, ensuring regulatory compliance, and strategic decision-making. Using appropriate tools and systems can streamline this process, providing timely and critical insights into your loan portfolio's performance. Follow Platform's charges for late or non-payment. The Follow platform, like many other online service platforms, has a specific policy in place to handle late or non-payments by users. They understand that unavoidable circumstances can sometimes result in late payments. However, consistent non-payment or late payment is not fair to the service providers on the platform, and hence they may impose certain charges or penalties. Typically, the platform will send a reminder to the customer for any unpaid charges. If the payment is still not made, late fees may be added to the original charge. The late fee can either be a flat rate or a percentage of the amount owed, and it usually increases the longer the payment goes unpaid. If payment is not received after several reminders, the Follow platform may take further steps. This could include suspending or terminating the user's account. This ensures that service providers on the platform are not continuously providing services without receiving payment. Moreover, in some cases, the outstanding debt may be turned over to a collections agency. This will impact the user's credit score and make it more difficult for them to get credit in the future. It's also important to note that users are also responsible for any costs associated with collecting the unpaid fees, including but not limited to legal fees, collection agency fees, and interest. This policy promotes a culture of prompt payments, which are crucial for the smooth operation of the platform and fair treatment of the service providers. However, the specifics of these charges or penalties may vary, and it's always a good practice to thoroughly review the terms and conditions or payment policy of the platform. Reinvest any returns or payments received. Reinvesting any returns or payments received is a growth strategy that involves taking earned dividends, interest, or any cash inflow from your investments and putting it back into the investment. This strategy is particularly beneficial for long-term wealth accumulation due to the power of compound interest. Compound interest is the process of earning interest on both the initial investment and the interest that has already been received. Hence, reinvesting the money that you earn can significantly boost the growth of your investment over time. For instance, if you own a stock that pays dividends, you can choose to use the dividend payout to purchase more shares of the stock, thus increasing the overall value of your investment. Aside from growing your investment portfolio, reinvesting returns can also balance out fluctuations in market events. Over time, stocks and other assets fluctuate in price. If you regularly reinvest your returns, you have the chance to buy in at a variety of price points. This tactic is also known as dollar cost averaging. Moreover, reinvesting doesn't only apply to investing in securities. For businesses, reinvestment might mean using profits to improve business operations, like upgrading equipment or technology, research and development, or expanding the workforce. These actions can potentially lead to increased productivity or sales, therefore creating more profits in the long run. Opting to reinvest returns, instead of taking out the cash, also comes with potential tax benefit. In many jurisdictions, money that is reinvested often contains tax advantages, which can lead to more savings in tax obligations. However, reinvesting should also be done strategically. It's vital to consider the financial health of the investment, market conditions, and your personal financial goals. It's also crucial to maintain a balanced and diversified portfolio to minimize risk. In conclusion, reinvesting any returns or payments received could be a powerful strategy for boosting the overall value of your investments and accelerating wealth accumulation. In both personal and business financial management, understanding and implementing this strategy could yield significant long-term benefits. Utilize microloan platforms as another option. Microloan platforms have been gaining popularity over the years as an alternative to traditional lending sources such as banks. These platforms operate in a simple way. People who have some money to invest lend small amounts to those who need funds for various purposes, often entrepreneurs or small businesses who may have difficulty obtaining financing from conventional sources. The platforms usually act as intermediaries, connecting lenders and borrowers while handling transaction logistics and risk management, providing a convenient option for both sides. Microloan platforms are a particularly attractive option for those who need small amounts of money to finance their ideas or business ventures. The reality is that many startups and small businesses struggle to secure financing through traditional methods. But microloan platforms bridge this gap by enabling them to borrow small amounts from a number of people. This helps diversify lending risk across many lenders rather than placing it all on one lending institution. For lenders, microloan platforms offer another opportunity to diversify their investment portfolio. By lending small amounts to a number of different borrowers, they can spread their risk across a range of different ventures. Many microloan platforms also do much of the legwork in terms of assessing the creditworthiness of borrowers and managing the loan repayment process, making things easier for lenders. Moreover, microloan platforms often appeal to investors who wish to make a positive social impact in addition to earning a return on their investment. These social enterprises show a clear impact by providing essential financial services to underserved segments of the population, including women, minorities, and those living in rural areas. However, potential users of such platforms should be aware that there are risks associated with this form of lending. For instance, there's the risk of default, which could result in losses for the lender. Therefore, as this form of lending becomes more popular, proper structures need to be implemented to ensure best practices are adhered to, reducing risks for both borrowers and lenders. Platforms such as Kiva, Acción, and Zidisha are some examples of microloan platforms that can have significant positive economic and social impacts. However, each platform has its own unique set of terms, requirements, and potential benefits, so potential investors and borrowers are advised to thoroughly research each platform to understand its specific opportunities and risks. Understand the risk of microloan lending. Microloan lending has gained popularity as a means of providing financial support to small business ventures, particularly in developing countries. However, like any financial activity, microloan lending comes with its own set of risks that both borrowers and lenders must understand. Credit risk. The borrowers of microloans are often individuals or small businesses that may not have a stable income or secure job. This makes the repayment of loans uncertain, leading to a high credit risk for lenders. High interest rates. To cover the costs and risks associated with microloan lending, lenders may charge high interest rates. This can add to financial burden of borrowers, leading to a higher probability of default. Lack of collateral. Most of microloans are unsecured. This means the borrowers do not need to provide any assets as collateral. If the borrower defaults, the lender has little to no means of recouping the loan amount. Regulatory risk. Microloan lending often falls under less formal banking structures, and in developing countries, regulations may not be clearly defined or effectively enforced. This adds a layer of risk for the lenders. Operational risk. Microloan lenders often operate in regions that are difficult to reach or politically unstable. Natural disasters, security challenges, and political issues like corruption can disrupt loan disbursement and repayment. Social impact. There is a risk that rather than alleviating poverty, microloans may actually exacerbate it. For example, individuals may use the loans to buy non-productive but necessary items, such as food or medicine, rather than investing in income-generating activities. This may create a cycle of debt rather than fostering entrepreneurial growth. Currency risk. For international lenders, there is a risk related to currency fluctuations. If the local currency depreciates, the value of repayments in the lender's currency will decrease. In conclusion, while microloan lending can provide much-needed capital to individuals and small businesses, it is not without its risks. Lenders must conduct thorough due diligence and apply robust risk management strategies, whilst borrowers must ensure that they can afford to service the debt. Select potential projects based on your interest and expectations. Choosing potential projects based on your interest and expectations requires careful consideration. It's crucial you select projects that align with your professional and personal goals to ensure long-term satisfaction and success. Passion and interest. Choose projects that align with your passions and interests. Working on projects you're excited about can motivate you to perform your best and keep you engaged, not only making the work more enjoyable, but often leading to better outcomes. Skill development. Evaluate potential projects based on skills you wish to develop or enhance. If you wish to grow your skills in a specific area, look for projects that provide opportunities to use or expand upon these skills. Challenge. Some people thrive when faced with challenging tasks that push their limits. If you are one of those individuals, select projects that stretch your abilities and offer room for personal and professional growth. Impact. Consider projects that have prospects of making a meaningful impact. Projects that align with your values and have a positive influence on society or the company often give a higher sense of gratification. Financial expectations. Some might prioritize financially rewarding projects. If income is a crucial factor for you, consider the prospects of financial rewards that accompany a potential project. Time commitment. Projects vary vastly in the amount of time they require. Some may demand a few hours a week, while others might need full-time dedication. Choose projects that fit within your schedule and time commitments. Future opportunities. Look at the potential opportunities a project could open up for you in the future. It might not be the perfect project right now, but if it provides a stepping stone towards your ultimate career goals, it could be worth considering. By focusing on these factors, you can ensure that you select projects that meet your personal and professional expectations and provide the opportunity for growth and satisfaction. Lend and get repaid over time. Lending and getting repaid over time is a principle fundamental to the concept of loans and debt financing. When you lend money to someone, whether it's a friend, a family member, or even a business, the expectation is that they will repay you over a certain period of time with a certain amount of interest. In a more formal loan arrangement with a financial institution or through a peer-to-peer lending platform, the terms of repayment are clearly defined and legally enforceable. These terms include the repayment schedule, typically on a monthly basis, the interest rate charged, and the total amount to be repaid over the life of the loan. The interest is the borrower's cost of borrowing your money, and it's how you make a profit on the loan. The interest rate is often fixed, but it can also be variable based on certain benchmark interest rates. Receiving repayment over time has several benefits. Firstly, it offers a predictable income stream, which can be very reassuring, especially if you're relying on this income for your own expenses. Secondly, as you are paid back over time, you can re-lend the repaid amounts to achieve compound interest and thus enhance your returns. There are also some risks involved in lending money and getting repaid over time. The main one being that the borrower may default on the loan, which means they stop making their scheduled payments. To mitigate this risk, lenders often use credit checks to evaluate the borrower's ability to repay the loan. Overall, lending and getting repaid over time is an excellent way to grow wealth incrementally when done wisely and carefully. It involves a good understanding of the borrower's reliability, the terms of the loan, and a firm commitment to honor the agreed-upon repayment plan to ensure that both parties involved are benefited. Alright everyone, that's it for today's episode. We hope you enjoyed it as much as we did preparing it for you. If you found value in this, and want to be the first to be notified about more content like this, please hit that subscribe button below. It helps us to connect with you better and makes sure you don't miss out on our upcoming content. Don't forget to show your support by giving us a thumbs up. We'd love to hear your thoughts, So please do leave us a comment about what you like the most about today's video, or maybe what you'd like us to cover next. Your feedback really counts. Remember to activate the post notifications bell, so you'll be notified every time we post a new video. Before you go, why not check out this other video we think you'll enjoy? You can find it right here on your screen. Thanks so much for joining us today. We look forward to seeing you in our next video. Until then, take care and stay safe.